You also handled UTI large cap, which I believe was master share originally, right?
Yeah,
Way back 1986,
Right.
at one of the
True.
flagship in terms of as a fund.
Right.
So, what does it make you feel that when you are handling such a legacy fund?
A long history, clearly. I mean, one of the oldest funds in the country. Like you said, I mean, right from 1986, when I was taking over this fund, over 35 years of legacy.
Now, which sector should an investor look out for, or what is your thoughts on that?
As far as sectors are concerned, when you look at it from a next 5-10 years perspective, India's clear advantage when we compare with other economies is the
We have seen quite a lot of MNCs. They have the Indian subsidiaries out here. So how do you see this MNC subsidiaries performing?
So MNCs, many of these MNC companies get their support from the parent, whether it's
Hello and welcome to Ventura Spotlight, a podcast series that brings you thoughtful conversations with minds shaping India's investment landscape, exploring their philosophies, experiences, and the lessons they have gathered along the way. In this episode, we are pleased to have with us Mr. Karthikraj Lakshmanan, Senior Vice President and Fund Manager Equity at UTI Mutual Fund. Karthik Raj is a chartered accountant and holds a postgraduate degree in business management from SP Jain Institute of Management Studies and Research. He is also a CFA charter holder from the CFA Institute of USA. With a strong research driven background and with over 20 years of experience in equity investing, he manages some of the flagship schemes at UTI, including the UTI Large Cap Fund, the Multi Cap Fund, and the MNC Fund, with a total AUM of around 18,000 crores. So let's get started. Hi, Karthik.
Right.
So, Karthik, we always start with beginning that to understand that how did you get into this equity journey? In terms of yes, markets are very exciting, but how did you get into this journey? I think it would help us to understand
right.
you better.
So during B school days, I mean, corporate valuation was a subject that was very interesting. I've had a liking for numbers, anyways. At that time, whatever little savings I had and a couple of friends who had, we dabbled into the markets and invested or probably traded at that time, and that's where got fascinated with this and eventually took this as a career path.
Any particular incident you remember which ignited more to get into the fund management role?
Again, same thing. I mean, the subject we started with the DCF, and it was quite fascinating. I mean, Excel again. Within a minute, we could change the output from one end to the other, and that's where we realized the importance of assumptions, and that's where it all started.
Okay. Good. And can you tell us that a little bit about your journey in terms of before your UTI and how did you land up in UTI?
Right. So I started with Goldman Sachs in Bangalore, supporting a US team, sell side team. And from there, I moved to ICICI Prudential Asset Management. I was in the PMS team there doing research, equity research. And post that, I've been with BNP Paribas, which got merged with again Baroda and became Baroda BNP. So there I was there for 14 years on the PMS side initially, handling PMS and offshore, and eventually moved on to the mutual fund side, handled large cap consumption tax fund there. And for the last 3 years, I've been with UTI Mutual Fund.
Oh, great. So I think we have a fairly long
Yeah.
journey as
True.
such, and I'm sure you have seen quite a lot of market cycles as well.
Clearly, yeah. Close to 2 decades.
Since you mentioned that you also handled UTI large cap, which I believe was master share originally, right?
Yeah.
Way back 1986,
Right.
one of the
True.
flagship in terms of as a fund.
Right.
So, what does it make you feel that when you are handling such a legacy fund?
A long history, clearly. I mean, one of the oldest funds in the country. Like you said, I mean, right from 1986, when I was taking over this fund, over 35 years of legacy. Swati Kulkarni was handling this fund
Right.
for close to 2 decades. When she was superannuating that time, I joined UTI and I took over this fund, and it's been renamed as UTI Large Cap. So it's a long legacy. There are many people who are associated with the fund as investors, unit holders, right from the beginning. It's a big thing, and clearly, what helped is, like I said, I mean, I've handled the large cap category earlier, and the styles of both the funds were similar, and that's where it was easier for me to kind of fit in and take over this role.
Okay. So, and having a legacy fund, sometimes it is, good and sometimes it is bad, right? I
Mhm.
mean,
Mhm.
they're both the things. And you would also have your own
Mhm.
philosophy, which you have, nurtured over so many years, right?
Right.
So, did you have to transition the large cap fund into that, or what did you contribute towards making it a where it is today?
Right. So the thought process, like I said, I mean, the styles were similar. Both of us kind of had a blend kind of approach. And as far as the fund positioning is concerned, we didn't want to kind of tinker around with that. So we've always kept it the way whatever has been the fund strategy, we've kept it stable. So it's been more continuity rather than kind of changing the fund with the change in fund manager. So that's something that we've tried to follow. And anyways, I mean, style was more similar, and growth at reasonable price and a blend kind of an approach. So to that extent, it was a lot easier.
So, since you mentioned, GARP, right?
Right.
That's the
Right.
philosophy,
Right.
growth at reasonable price. So,
Right.
I mean, how do you balance between okay, this is a growth and you're getting at reasonable price. So, it would help us to, understand that how you are actually implementing it, and would love to have some examples of,
Right.
if you could really share. So,
Right, right. So the core strategy of the fund is competitive advantage, or moat in simpler language, or Warren Buffett term. So our idea is to identify businesses which have some kind of competitive advantage, which provides that earnings growth visibility. The longevity and the visibility of earnings is something that we look at in the businesses that we invest in. So that's the core. Along with that, like I said, I mean, the strategy is more of a blend wherein we have both growth stocks, or quality stocks, and value stocks as well. How do we differentiate between the two? I mean, in simple language, maybe you could say the high valued, I mean, a high PE or a high price to book companies would be more on the growth quality side, and the cheaper ones would be on the value side. But the real way to look at it is, I mean, if it is a high growth company and the cash flows and the growth outlook is strong enough, you can pay even a higher price. I mean, whether it's a higher price to book, or a higher price to free cash flow, or a higher price to earnings. On the other hand, there could be some businesses which may not have very high growth, but they're valued also similarly at a very low valuation, so that, I mean, their dividend yields or the cash flow yields are quite healthy, and to that extent, even at a lower growth, they make sense. So we could participate in both. I mean, we could have a very high growth company, I mean, industry plus say 5%, or it could be industry minus also, but as long as you have the right valuation. So we could have both, a lot more high growth, and some value opportunities also.
okay. Interesting. So, in fact, I was also just, yesterday I was also just doing a study, basically in terms of large cap as a category. Uh, it's one way a person can look as that it is very easy to invest because you have very good stocks,
Right.
in terms of quality of management
Right.
and what we look at it, right? However, trying to generate alpha,
Right.
and trying to beat that because you are restricted with that 100 stocks.
Right.
Being large cap as a category, so you have to have
Right.
80% invested in
Right.
these stocks, right? We also found that I think majority of the funds are also hugging the benchmark
Right.
in terms of their portfolio, right?
Right.
So how do you manage? How are you able to manage that? Do you do that, or you also follow the same?
Right.
Are in the same boat?
Yeah. No, so if you look at the category itself, since I handle other funds as well, manage other funds as well, the category, like you mentioned clearly, I mean, the restrictions are a lot higher here. I mean, it's 80%, maybe other categories it's 65%, say maybe a mid cap or small cap. So to that extent, the restriction is a little higher here, and the number of companies is top 100. And within that, again, the top 10 tend to be higher index weights, also more liquid, and they're prominent businesses across sectors. So often there is a concentration there, even whether it's index or even in the portfolios of the fund managers. Those are the nuances. I mean, compared to other categories, this is how large cap is. But the fact remains that majority of the wealth is being created in the large caps over the last 1-2 decades. And to that extent, for any investor looking at Indian equities, in their journey, they will need to participate in these large caps. Like you rightly highlighted, many of them have seen many cycles. Some of them would have been mid caps, small caps in the past, and or I mean smaller companies or mid companies, and they've grown and eventually become this large and become in the become part of the top 100 companies. So they would have seen those cycles. The balance sheets would have got stronger, and because of that, their ability to tide through cycles and their ability to kind of come out as winners or survive is far higher compared to mid and small caps. Especially in small caps, probably the mortality risk would be higher. I mean, many of those companies may not exist a few years or decades out. So compared to that, the chances are higher in large cap that they would kind of be better off. So from an investor perspective, this is a category that is definitely required. Now coming to the way we look at the fund, clearly 80% in the top 100 companies. And beyond that, there is at least a 15% or 15 to 20% kind of room where we can invest outside the top 100 companies. There we could have some high growth companies either from mid cap or small cap, or they could be leaders in their categories, but by market cap definition, they could be mid cap or small cap. Those could be promising, and to that extent, we can have some exposure there as well. Or companies which are likely to become large caps, they are growing much faster. They are mid caps today, but probably 3-5 years down the line, they could be large caps. Those are the companies there which we could clearly evaluate and hold outside the benchmark. And within the benchmark, the 100 companies at any point in time, we'll have to look at both the aspects, the competitive advantage and whether the valuations that we are paying is right.
Okay. So you mentioned about weathering the cycle, right? So what signals do you look at in a company
Right.
that that they are able to weather the cycles, the multiple cycles a company goes through, right?
Right.
And I mean, I'm actually looking at something beyond the balance sheet.
Right.
I mean, one is the balance sheet where you would look at.
Right.
So beyond that, what signals do you look at for in a company?
I think clearly one of the strongest competitive advantage would be the cost advantage. I mean, the lowest cost producers could often be the last man standing, even if there is a down cycle in the industry, in the sector, or even in the overall markets itself. So that's where the cost control or the cost advantage is one of the biggest competitive advantage that companies can have, which can differentiate them from the rest of the pack, especially in a downturn.
Okay. So since you manage multiple funds, right? So across your funds, how do you what is your philosophy you follow in terms of churning the portfolio? There are contradictory views on that. One is that you say that you have to buy and hold. Okay, that is one strategy. that
Mhm. Mhm.
you buy and you
Right.
have a longer term view and do that. There is also one school of thought which says that if I'm giving money to a fund manager, I want him to be quick and nimble and
Mhm.
take
Hmm.
calls faster, right? So there
Right.
is one thing which will say that you have to churn your portfolio,
Right.
whether churning is good or bad,
Right.
and we measure it by way
Right.
of a turnover ratio
Right.
in terms of
Right.
that.
Right.
So one is that I want to understand your churn philosophy,
Right.
and also if you can let us know specifically for
Mhm.
viewers of the podcast
Mhm.
that what they should look at in a turnover ratio from a
Right.
fund manager perspective.
Right. Right. Yeah.
Now since you have been there
Right.
for quite a
Right.
number of years, seen
Right.
multiple cycles,
Right.
you
Yeah.
know so
True.
if you could throw some light on that.
Right. So clearly, I mean, there's no one single strategy which will work all the time. Each one, whatever is suitable for them and what is their communication as far as their fund strategy is, they will have to take a call according to that. As far as our large cap fund is concerned, we talk about competitive advantage, which doesn't change overnight. I mean, always there could be a kind of increase or decrease in the competitive advantage for companies also, because it's a dynamic world. But at the same time, it's not going to happen very rapidly, and to that extent, many of the companies could be largely buy and hold. Having said that, since it's growth at reasonable price and not growth at any price, if the valuations become higher than what would be comfortable, I mean, it's not an exact science that you say at this price will completely exit. But I mean, if it gets expensive, probably the way to kind of handle that is you reduce the exposure there. So that could add to some amount of turnover. But overall, considering that it's more of a long-term oriented, competitive advantage focused fund, the turnover tends to be little on the lower side if we have to compare with other funds as such. Now, I mean, a category, I mean, a multi-cap is something that I handle, where we have three subcategories within that: large 25, mid 25, and small 25. And there's a very large universe there of, I mean, the all the listed companies within that. Whatever is in our coverage, we can participate in that. So to that extent, the opportunities there can be a little higher. So compared to probably a large cap, multi cap could have a slightly higher turnover ratio. But by nature, can it be overall a very high portfolio turnover ratio means, I mean, probably then as long as you're looking at the long term fundamentals and you're basing your decisions on that, the higher turnover ratio may be negative. Reasonable, moderate turnover ratio is something that is good.
Okay, so you are not a advocate of a higher churn in the portfolio.
Right.
Am I
Yeah,
understanding it
yeah,
correctly?
yeah. From
Okay.
I mean, especially since equity is, I mean, this is a long-term asset class.
Hmm.
Many of these calls that you take may play out over a longer period of time, and to that extent, you'll have to hold on to those companies for a much longer time.
So just as a counter on that as a question. So basically, it's you're saying that the company playing out to your theme and your philosophy and your
True,
thought process, right?
true.
So are you able to share any of your past experiences where you have had this time where you feel that something played out exactly the way I wanted? Is there anything something like that which you can share?
Right. There are many examples. I mean, some would be, I mean, for example, on the retail side, we've had probably a value fashion as a category where, I mean, a company which is focused a lot more on throughput per square
Hmm.
feet or throughput per store. That's kind of sweating the assets much more efficiently. That played out well in terms of, I mean, the company making good profits at the single store level, and obviously expanding much faster than many of the competition. I think there are examples across sectors where there would be some where you've got the calls right, and some could play out very differently from what
So,
initial
so retail is
hypothesis was.
something which
Right,
played out for you as
right. In the
this.
past, yes.
Okay,
Yeah.
very good. So, economies of scale. are there in large caps, right?
True.
So now, which sector should an investor look out for, or what is your thoughts on that? With now we are having so many IPOs coming in, and many are also landing up entering in the large cap space itself only.
Right.
Like we had examples of Zomato coming in, then getting into large cap, bordering between large and mid cap. Create some of the new sectors are coming in. So, any interesting sector you have found that this is a sector or a theme which will is likely to play out over the next 4 5 years?
Right. I mean, again, there are many sectors. First, coming to the economies of scale, we believe. I mean, economics. There are many sectors where economies of scale clearly benefits. I mean, probably banks. I mean, the kind of tech spends that they need to do to kind of upgrade themselves and be at it. I mean, at the forefront in the kind of banking sector. The larger banks would be at a bigger advantage compared to many of the mid-sized or smaller banks, clearly. Again, similar for probably FMCG, cement, telecom, where I mean to reach a wider audience, create a brand for themselves. I mean, there is huge costs involved, and clearly size clearly helps. It could be in branding, it could be additional capex. In case of cement, I mean, a brownfield capex would be at a far lower cost than greenfield, and to that extent, the large clearly adding capacity at a much faster pace than the smaller ones. Again, telecom, I mean, it's clearly seen a consolidation from multiple players to hardly three players now. So that way, sector after sector, I mean, there's been advantage of the large companies. Many of the large companies have become larger or gained market share. So that is something that we've seen clearly in India in the last 10 15 years. And as far as sectors are concerned, when you look at it from a next 5 10 years perspective, India's clear advantage when we compare with other economies is the demographics. We're still young nation, at least for the next 10 years. Um, so that youth advantage, there'll be more people coming to the job market. Urbanization is something that will happen. You'll have again financialization picking up in a big way, and a lot of people moving from middle income to upper middle income. So the discretionary consumption or luxury consumption, travel, these are sectors that can definitely pick up. And again, we are seeing unorganized to organized in many sectors. So that's something which could lead to growth, especially retail. You're seeing whether it's fashion, value, grocery, you're seeing unorganized to organized shift. So these are the sectors where we believe that from the next 5 10 years, there's growth opportunities. Clearly.
Okay. Now, we have we have seen quite a lot of MNCs. They have the Indian subsidiaries out here.
Right.
Uh, Most of them have rich valuations
Right.
as well, right? So we are expecting that they will have a better growth. Quality is assured. However, when you see in terms of their market performance, right?
Mhm.
I think that they have lagged in terms of the general the whether we call the Nifty or whatever.
Mhm.
So how do you see the Indian subsidiary this MNC subsidiaries performing? I mean, do you see them adding more value from a shareholder perspective, or one should look at a broader category and not look at this category much? What are your thoughts on that?
Right. So MNCs, many of these MNC companies get their support from the parent, whether it's technology or I mean leadership, and clearly capital as a comfort that if at all there is a requirement, there is the parent. So overall, like you highlighted, many of these, it's generalization. There could always be exceptions, but generally what we see is many of these companies have good R&D capabilities at the parent level, and to that extent, they don't have to spend that. They get it for a royalty, and their asset light, their cash flows are quite strong. They're much better off in return ratios. So overall, the quality is much higher. So what has happened is over the last probably 10-15 years, these companies, many of them could have been in mid and small caps, smaller companies, undiscovered, but slowly they've got discovered, and this pack has got re-rated, and that's where we've seen their multiples. If we take a price to earnings multiples, their earnings, the P ratios have kept on inching up, and today probably they're much expensive than the broader market. So that's what has kind of created a good returns for this category. Generally, the from a sector perspective, MNC as a category is widespread. You have companies in FMCG, you have in auto, pharma, IT, industrials across. Um, but however, what we've seen is many of these companies, since I mean there is a global leadership which kind of strategizes in many cases, and the CEO changes also happen a little faster in some cases. They've been more aligned to the parent thought process, and to that extent, the growth has been more measured. While the cash flows are healthy, return ratios are healthy, they've been on a growth front. Overall, when we look at the broader market, many of these companies could be little more measured. Thankfully, that is changing. Many of these global leaders do recognize that India is the place to be in. And to that extent, they're committed to kind of even increasing exposure here, or increasing capacities here. We are seeing few companies getting listed now because the valuations are also good, and clearly India, the growth opportunity is also good. So to that extent, you're seeing opportunities where, I mean, many of these parents also increase the focus on these MNC companies, and to that extent, the growth could pick up. And also now, I mean, from when we are talking specifically about MNC fund as such, I mean, now MNCs, we do have exporters also,
Okay.
which are also part of the MNC group. So we could have more opportunities in IT, pharma, auto ancillaries,
Okay.
capital goods, which could also be higher growth. These could be Indian companies which are having exposure abroad as well.
Okay. Interesting. Okay. Now, every fund manager's dream is to outperform the benchmark. That is creating alpha, right?
Right.
And specifically in a large cap fund,
Mhm.
it's a huge challenge,
True.
right? So, what is your strategy, and what are the things that you look at doing? I
Right.
mean, as a fund manager,
Right.
to do that. How do you create alpha in a large cap fund?
Right. So the thought process is again similar. I mean, from a top 100 companies, we need to have at least 80-85% exposure there. There, you have the filter of competitive advantage. We have our internal process of score alpha, where we kind of screen all these companies on their return, the ROC profile, on their operating cash flow profile. Based on that, we kind of identify the companies, and like I said, I mean, it's a blend portfolio. So within this 100 companies, idea is to have those competitive advantage companies. Where it helps is, especially when there is a sharp downtick in the market. I mean, if you have say more than 15-20% correction in the market, which keeps happening every now and then, at least 2-3 years or 5 years, you often have one such period. So in those corrections, this companies with competitive advantage tend to kind of fall less or outperform. So that's the down capture when there is a market correction. If you're able to kind of create alpha by falling less, that is something which is positive over a longer period of time in the journey of kind of running the fund. So that is one way, and the other clear way is, I mean, like I said, I mean, we still have room to have at least 10-15% exposure outside even the top 100 companies, where again the filters are same, the process is same, but they could be mid cap or small cap because of the market cap definition, but eventually some of them could become large cap, or they could provide high growth, or they could be leaders in their particular sector or subsector. So those companies can also be part of the portfolio, where eventually, if we believe, I mean, they may grow faster, and to that extent, that could also be an area of creating alpha or outperformance.
So basically, you look at companies outside the ambit of the large caps
Yeah,
So more
it
into
has
mid
to
and
be
small cap.
anyways 80+% has to be
Yeah,
large cap.
correct,
So it's
correct.
just the added advantage is what
So
you
that is
get
the
outside.
one which will
Right,
actually give the
right,
kicker on the
right,
return part of it. Okay,
right. Yeah.
thanks. Now, supposing you had to, create a portfolio, if it is, and you do not have the restrictions of doing any categorization. So, one is that, how would you create your portfolio as what would you have as large, mid, and small cap?
Mm-hmm.
Let's assume that it's a long term
Mm-hmm.
horizon,
Mm-hmm.
and what characteristics
Mm-hmm.
in terms of maybe it could be sectors or something that you would
Mm-hmm.
love, not stocks.
Mm-hmm.
I know
Mm-hmm.
you have a restriction on
True.
mentioning that. What is it that you would look as characteristics in terms of creating a portfolio like that?
Yeah, so I mean, India is clearly a growth market, and we still believe, I mean, it will have one of the highest growth across economies. And to that extent, there could be a lot of ideas on the growth side. So growth is something that would want to look at from a core portfolio if I'm holding it for the next 5-10 years. Growth and obviously eventually, I mean, free cash flow is something that we need to look at. I mean, that's where even in our process, the focus is a lot more on ROC and the cash flows. While I mean, a high growth company initially may not have very high free cash flow, but as they mature and hit a steady state, there could be a lot of free cash flows. Eventually, I mean, any business that you're buying for the free cash flows that they can generate. And to that extent, would look at companies which can generate healthy free cash flows over a longer period of time, say next 5, 10, 15 years. That's the tilt that we would have from a core portfolio perspective. But time to time, like I said, I mean, in the market, you will always have opportunities. There could be a sector or a company going through a rough patch for some reason. I mean, it's a downturn, or there's some management change, or there is some external concerns. But eventually, you believe the company can bounce back or the sector can bounce back. Those can be the transformational opportunities. Some of them could be value opportunities that they're at such a price to earnings or such a valuation where the cash flows are enough to justify for you to buy even if at all there is no growth. So the core would still be some of these growth opportunities, but tactically there is going to be always opportunities on the other side as well.
Okay. And if you had to, choose on a market cap and not going by, any restriction, what would you actually choose?
Again, I think market cap, we've seen time and again, there are companies, a large company itself growing faster than many others for a long period of time as well. So you could have high growth company in large caps also and equally in mid and small caps as well. So I would not put it that we'll find opportunities only in a particular bucket. It could be across market capitalization. In fact, over a longer period of time, we've seen, I mean, if the last 5-6 years, if you take the growth of a large, mid, and small category, top line growth has not been very different. The profit growths have been different because the profit margins for mid and small cap from a low levels has improved dramatically post COVID. But at the category level, you have a similar kind of growth. Within that, you have to pick the high growth companies, which is possible in all three categories.
Okay. See, markets are exciting. Okay, every day it has its ups and downs. Also creates sometimes stress levels at times, right? So, how do you de-stress yourself apart from the market? What's your go-to thing?
Right. I think reading books, listening to music, movies on OTT, these are the standard ones.
Acha,
Yeah.
okay.
Right.
Uh, we always do a rapid fire. So I would
Right.
like to do a rapid fire with you.
Sure.
Okay. So the first one, a hobby you wish you had more time for.
Again, reading. I am a slow reader. I like to read, but I'm a slow reader to that extent. Would love a lot more time.
Okay. Leadership quality you value in promoters.
Energy or passion. I mean, you find some of these CEOs or leaders. You talk to them. They're so energetic that it kind of rubs off on you as well. So that is something that I look up to.
Okay. If you could take a week long break with zero market updates, where would you disappear to?
think probably a road trip with family anywhere.
Okay.
Yeah.
Which app do you instinctively open first thing in the morning?
Bloomberg.
Okay.
Yeah.
When you finally step out of the fund manager mode, what's the first thing you tell yourself?
I think chill, take life easy.
Okay.
Correct.
Who's tougher for you? What's tougher for you? Skipping dessert or skipping morning news?
I think both.
Both.
Right.
If your friends had to guess your ideal holiday, would they say culture trip, escape, or anywhere with good food?
Uh, Maybe nature escape.
So thanks, Karthik. It was
Thank you.
a pleasure having you on our Ventura Spotlight. Thank you very
Thank you.
much.
Thank you for having me here.
Thanks for tuning in. If you enjoyed this video, hit the like button and subscribe for more content that makes your financial journey smarter with Ventura. Mutual fund investments are subject to market risk. Read all scheme related documents carefully